I'm curious if the fundraising journey for VCs trying to get capital from you and the fundraising journey for startup founders, are they quite similar actually? Or, the metrics must be different, but is it a similar process?
That rigor, that governance structure, that makes sure that the industry here is not going to have any flaws or breaks when it comes to malreporting, malpractice, and all of that. And that all starts with the people who are providing that capital. You don't want to add layers of complexity at an early stage startup. You want them to learn, grow, and learn really fast, right? So as the cost of capital goes up, valuations go down. So I'm very, very bullish about what this year is going to look like overall for the industry. We are getting hints that interest rates are going to go down. The one thing that I'm wary of is the pressure is coming from an investor group that's saying, I want returns faster than before.
Hello, welcome to the Lucidity Insights podcast and our special series, The Perfect Pitch. Today, I have with me none other than Nader Albastaki, who is the managing director at Dubai Future District Fund. So excited to have you here, Nader.
Thanks for having me.
Yeah.
Excited to be here.
So first and foremost, as managing director, my understanding is that your role is strategy and ecosystem development. Tell me what that entails at DFDF.
So there are two types of business models when it comes to venture capital. There's a pure capital allocator, and then there's an allocator plus. And that's what we're developing under sort of my remit is how do we help portfolio companies grow by putting them side by side with the ecosystem, building up and supporting the ecosystem for its needs, and so serving our portfolio to grow as well. So a big part of my role is externally facing, and a lot of it's internally. By internally, I mean looking at our portfolio and what they need to grow, to prosper, and working with the ecosystem. This means corporates, this means government, this means regulators, and working side by side to make the whole ecosystem flourish on both ends of the spectrum. That comes with a lot of support mechanisms that we'd have to build internally, whether it's a setup of the team, when it comes to strategy, supporting when it comes to discussing their highs, their wins, and celebrating them alongside one another. So a lot of that needs to come side by side when we talk about the plus side of the business model of VC, and that's what I'm here to do at Dubai Future District Fund.
Okay. And most of your portfolio companies, they're growth stage, correct? That you guys invest in?
We invest in everything from pre-seed, seed, up to Series A and B, and we follow on up to Series C as a fund.
Okay, so technically, if you're doing seed, does that mean that startups that come to you don't yet have traction?
In a lot of cases, yes. So they're either well into sort of building up towards their minimum viable product or MVP, or in some cases, they're just about to go to market and they're coming to us to help them to go to market. And in some cases, they've already hit that traction and they're starting to hit, as you put it, their growth stage and how we can help them scaling their business up.
Okay. And in terms of, Sharif came on the show already, and one of his biggest pet peeves was founders don't do enough research on what we invest in before they approach us. And so maybe you can spell it out for everyone out here. What does DFDF invest in? What's your investment thesis? So you've already mapped out the growth stage. What kind of startups are you looking for, and when do you want them to come and approach you?
Maybe if I take one step further back from that as well as what does VC invest in? Because that's part of our pet peeves is we get people that are doing amazing things, but are they the right fit for VC in general? And then what does it look like within our mandate and what we're here to do as a fund as well? And the main thing there is, if you're a business that's serving a local need, a more regional need, and your path to profitability is relatively short, that's not VC investments. VC investments is looking for what is that thing that is a global need, is a pan-regional need, and it needs to scale up quite fast because it needs that traction to support its momentum and its growth. Being first to market, solving a relatively large need regionally, globally. So that's the first thing I want to point out, is that, and that ability to scale up. So having the stack that allows you to scale up. In our case, we generally look at technology companies, but there are other models that are scalable as well. So in our case, technology that fall into a few different buckets. Number one is a bucket we call the future of finance. So this is everything from fintech, insurtech, to the ecosystem around those two sectors. So regulatory technologies, infrastructure technologies that support this theme of the future of finance. But we also look at embedded use cases of finance in other sectors as well. So we call that embedded financial plays. And those are interesting. So whether they fall into logistical companies, but they're literally solving for a financial need within that sector, we'd look at that within this spectrum.
Is that like giving credit on the back end of a really specific sector, like logistics, for example, or restaurant SaaS that understand, or procurement, B2B procurement on the back end?
Absolutely. So it would be supporting rails to those sectors, as you rightly put it. So it could be payments, it could be enablement, credit, in many different shapes and forms within that spectrum of finance.
Okay.
But what we also look at is another big part of our investment themes around the future of economies. Now, that's quite broad. What we've narrowed down to is 8 different sectors. I can go into them in detail, but that'll take the whole of our session. But at a very high level, we've made deployments into the future of health, the future of work, the future of entertainment, the future of AI, for example, as many different themes that we've looked at. And there are a few others as well that are supporting what I like to look at is ecosystem needs. So over here, we're in a trading environment, a cross-cultural environment where we enable, as Dubai, as the UAE, business between different parts of the world. So trade, logistics, movement is a big part of the business model here. Enablement of that through financial products is a big part of that. Well, showcasing that is a big part of that. So using the ecosystem and the size of the ecosystem when it comes to economic contributors, we look at that and we look at the needs within those parts of the sectors. That helps us sort of build part of our thesis. The other part of our thesis is, where is this all going in the next 10 years and the next 50 years? So what are those rails towards the next 50 that are going to be the right times to invest in the next 10 years and will be ready for the market in the next 5 to 10. And that's a big part of how we build our thesis as well within these thematic sectors.
I love that. Something else that makes DFDF unique is that you are essentially the government's investment arm. And so I'm curious, what do you think that changes with regards to how DFDF operates? I'm talking less on the fund-to-fund side, but well, maybe as a whole. But really, when you're looking at what kind of startups to fund, I can already see some linkages here with that 50-year strategy of maybe where Dubai is going as well. But can you speak a little bit into that? What makes you guys a little bit different from all the other private VCs out here?
What's exciting about the way that we were set up as an entity is we were set up as an evergreen structure to begin with. So we don't have that fixed 10 plus 1 plus 1 model that across the board the VC industry primarily focuses on in terms of business model. There are a few that go...
By that, you mean there needs to be real profit, like vintages and profits at every funding stage.
Exactly. So those VCs would collect capital from investors that are expecting that money to be deployed over a certain period of time, then supporting those portfolios grow for a certain period of time, and then over time find means of finding them liquidity options, whether it's an M&A activity, an IPO, etc. That whole process creates the returns on the fund, and those investors expect it within that 10 to 12-year horizon, which is that expectations that set off the beginning. In our case, we don't have that. We have an evergreen structure that allows for us to hold for a little bit longer. What does that mean in terms of practice? If anything falls within sort of the remit or would be best housed in one of our portfolio funds, for example, we would make those introductions because it would make sense for us to say this is a better fit for Fund X, for example, in terms of what they're looking at. Or in some cases where we put on that government hat is we see this as a systematic or a strategic play for the wider ecosystem, and going side by side with other funds in the ecosystem to support a player that requires some additional capital in a strategic manner as well. So connecting them to the government, to policymakers, to regulators as well. There's a lot of value to be added by having us side by side with the ecosystem investing in some of these startups. And ultimately, where I started is that patient capital play allows for us to invest in longer term plays that might take maybe 15 years to fruition, 20 years to fruition. It takes a lot more upfront building, R&D, and sort of getting across to the marketplace. So if they are going to the market and it's a completely new sector that hasn't been touched before within an overall sector, so a new subsector, that takes a longer time to go to market, educate, get people on board with it, with the problems that it's solving for, to then get that traction. And we have that opportunity to be that patient capital provider to allow for that to happen.
Interesting, because there's very few players in the region that are investing in those longer term plays like deep tech, for example. Is that something you guys are actually looking at and going actively, we are the player that can invest here?
Absolutely. So we've done that twofold. Number one is we've been quite active in terms of looking at funds that we'd want to participate with to make sure that we're bringing in the right know-how as a capital provider to that sector, and then looking at how we can invest more and more into that sector. We have some interesting upcoming news, but we'll wait until it is public.
Okay, well, I hope we get the first scoop.
Yeah.
The other thing that makes DFDF really unique is that you are one of a handful of funds in the region, which means that you are investing in venture capital funds, capitalizing them, who are in turn also making direct investments into startups. I'm curious from your standpoint, so you've got VCs coming through your door every day, pitching to you for their next fund, fundraising that way. You've got startups coming to you, fundraising in another way. I'm curious if the fundraising journey for VCs trying to get capital from you and the fundraising journey for startup founders, are they quite similar actually? Or, the metrics must be different, but is it a similar process?
No, is the short answer. Okay. But if I can elaborate a little bit. So on the VC side of things, one thing that's very important for us is that there's that rigor, that governance structure that makes sure that the industry here is not going to have any flaws or breaks when it comes to malreporting, malpractice, and all of that. And that all starts with the people who are providing that capital. If they're going to push the right ideals, the right practices down all the way to portfolio companies, that's where you have the biggest playing parts in terms of making sure that governance is the centerpiece of what's going on and best practice. When it comes to startups, it's more around enablement, and this goes into sort of what would I look for within a startup? Is that mission drive? Is that they want to solve for something that's bigger than the solution that they have at hand? So they're very different. You don't want to add layers of complexity at an early stage startup. You want them to learn, grow, and learn really fast, right? Mm-hmm. Whereas with an entity that you're investing into, you want to make sure that as an investor, as a limited partner going in and investing, you're in safe hands and they're pushing best practices down to the startups as well. So bringing in the right metrics, the right governance when the time is right. You don't want to overburden too early, but then not bring in the right practices when they are starting to scale up and grow.
Okay. So I'm hearing you say for startups, you are trying to just put some safety guardrails, but for the most part, allow them to be free to innovate and just move as quickly as possible.
Exactly.
But for VCs, you're saying actually from the get-go, if they're going to, raise a couple million from you guys as the LP, you want to make sure that the governance is in place and there's really stringent controls from the very beginning.
Absolutely.
Okay.
Yes.
Yeah, beautiful. Would totally make sense. Okay. Well, for all of the founders and entrepreneurs out there, what makes the perfect pitch?
I touched on it briefly, but that one point that I made around the mission is absolutely critical. Going in and understanding sort of the lay of the land of where you're looking to play and understanding what the problem statements are, the entire network of the value chain over there, and where you're looking to play is one part of it all. But if you're just doing it to make some returns, it's not enough. And the reason I say this is, there are ups and downs. The only thing that keeps you going isn't just dollars, it's that drive, multi-layered drive that comes with a mission. And that's what gets you out of those troughs a lot of the times. It keeps you ingrained with the founder community, the VC community, the people that are looking to have their problems solved. It's a round-the-clock job. It's a lot of tension. It's a lot of stress, and that is the number one thing that I would look at when I'm looking for the perfect pitch. Is that person on a mission to solve for something that's bigger than just the one solution? And the solution is part of a series of ways that they're looking to address this mission that they have. And the second part of it is really how well do they understand that space, whether it's on the engineering side, on the sector side, the pet peeves that the people on the other side of the table are trying to solve for. What are they driven by? And really getting a feel of who's there, what are they doing, how can we collaborate with the right people, how can we solve for the right problems, and that understanding is absolutely key. Now, there are very specific stuff that goes into a pitch, but really those are the two main things that I want to walk away and say, you know what, I really like that one person and what they're driven to be solving.
So, yeah, I hear this quite often. And I think, it's a mixture of passion and having the data and understanding of how to tackle and become number one in your market. But what would you say for those, I'm sure you can come up with a few people in your mind, but those founders, many who are super passionate about what they're doing, what are some of the pitfalls that they can fall into when it's all passion?
So I think one of the things that comes up is not everyone buys into your mission. There is a select group of people that are very passionate about that space. And I think one of the things is finding those people is very important. Going to people that have nothing to do with a certain sector might not have the right passion points for that sector, or they intend to invest, they intend to open up doors because it's not their specific area of expertise, or they haven't been exposed to it as much, and therefore may not be as excited about that space. So finding the right people with the right sort of excitement levels is a great part of, even if they're not going to invest in you, they'll set you in the right direction. They'll make you the right connections. They will open up doors, even if they're not going to invest in you. So I think that is a big part of sort of in the early days, finding that group of people that are on mission with you, or at least want to see you succeed the right way. This doesn't necessarily have to be friends and family. This can be people outside of those networks and your direct social networks that can be those enablers to your start.
Okay. Yeah, that's actually really, really great feedback. I think when founders get started, they just assume all investors are sort of investing in similar things. And so long as they have the right pitch, the data to back it up, and they're super passionate, they would be able to convince anyone. But that's a road down heartbreak lane, I think.
Yeah, I agree.
Is that part of your role at DFDF as ecosystem developer when you see one of your portfolio companies or even a new startup come to you and they're pitching a great idea? You're not sure if you want to invest in them yet, but you're connecting them to the right people to see how far they can take that idea down the road.
Absolutely. So my lens going in and assessing startups is really down the path of where am I seeing this problem set directly, and can I support them as well? Because a big part of it is, yeah, I see it. There's a big market for this, but what can I provide to you as DFDF, as Nader, and the ecosystem business that we've sort of put together as part of DFDF? And if I can't really value add to you, that's where I'm not doing the utmost to make sure that you are successful as a business. So part of it is understanding sort of our network of funds and their ecosystems to basically say, you know what, maybe you're better suited here and this is best for your future. Or if it was something that we think we can open up, is the question of how and at what time do we open up these opportunities as well. Mm-hmm. So I think it goes both ways, but to address your question directly, I think that is a big part of how we are looking at different solutions that come our way. Is can we support them to another level, and is our money and us being a part of their journey beneficial to both ourselves and them at the same time.
And this other layer is, if you guys fund a startup today, are they fundable down the line, and who else will come on board, right? How much of that due diligence is done right up front? And are you talking with a lot of your portfolio funds when you see something exciting and saying, hey, would you guys consider investing in this?
So that's a great question. And maybe I'll break it into three parts. One part of it is, so yeah, there are a few different, I guess, variables to look at. Is who are those partners that could co-invest with us or come in at later stages? Who are the exit opportunities, or what are the exit opportunities for the M&A activity or sort of route to market? And is there enough appetite out there on an M&A perspective or an IPO perspective for that type of entity, whether it's today or where we see the market heading?
I imagine that's difficult to do for the early stage players, but for the growth stage and later stage players that are coming to you, do you guys do this due diligence right off the beginning? And are you guys a lead investor? Do you guys lead rounds?
So we're not against leading rounds, but at the same time, it really comes down to A, capacity, and then B, are we the right people to lead a round? Number two is deal flow, as well as how many are we getting at a certain point in time. Would we be the ideal person at that moment in time to really look at this, or do we think someone else is that is co-investing alongside with us that we worked with in the past, for example?
Okay. Okay. And so if I'm a startup founder and I'm looking to start fundraising, when's a good time to come in and talk to DFDF? Should I have some lead investors already lined up? Should I have had multiple conversations outside beforehand? Or is DFDF, so long as we said, the research is done and you guys are investing in that sector and there seems to be some kind of alignment, should I be coming and knocking on your door?
So I have two perspectives on this question. I guess the first thing that comes to mind is, if DFDF, based on what we do and who we are, is the ideal investor and you're super early stage, I'd suggest going to a few people and testing your pitch out, because you don't want to be burning your opportunity with someone when you're not pitch ready, for example. So pitch readiness is a big part of getting the message across the right way and making sure that you're tackling all the key parts that an investment or an investor would be looking at. So for the ideal person and you're super early stage, I'd say test it out with a few people in the market that might not be your primary targets, but help you to get to pitch readiness. But if you're already someone that's in the market, that's a little bit more established, chances are we already know about you, and we'd probably be targeting you. But the other way around is that reputation that goes around the whole market knows one another at the end of the day. And that also helps with your pitch with any investor, even ourselves. Because at the end of the day, I mean, if you look at the cap table of any startup, for example, the first thing anyone does in a due diligence process is talk to them and say, are things going well? And it's very natural. And making sure that you do have a good reputation. People, whether it's the founder circles, whether it's the investors, everyone has a part to play in this ecosystem, and being ingrained with them, working with them, and not being siloed from them is a big part of being someone that's put out there as an all-star, and B, is supported by the wider ecosystem as well.
Okay, great. If I come in and pitch and I'm doing something that's one of your biggest pet peeves in a pitch or in an approach to pitch you, what is that?
Pet peeve, I guess at a very high level, talking about the solution full stop is a pet peeve, because at the end of the day, the solution isn't why I would be looking at investing in you. That's part of it, but it's you, the team, everything around you, the ecosystem, and an understanding of that. And what I've seen a few times is a fixation on the robustness of a solution and its multi-layers of how much better it is than their next best competitor. But that's only as good as your ability to sell, your ability to distribute, your ability to position that product, that solution, and making sure that it addresses the needs of the person on the other side. You might have the most tech-enabled solution to someone that's really looking for the most basic, cheapest solution on the other side. And is that a match? Are they looking for the creme de la creme car when you can give them a basic car and they're on a budget? So it's really aligning with market needs and not just really being fixated on how much better or how good this solution is in its own silo.
And so I'm hearing, the founding team, as I often hear, especially in earlier stages, founding team is super important. Would you put it, how would you rank it? Founding team versus product market fit and the idea?
I guess it comes down to how early they are. So if they're super early, I mean, it's founder, then what they're trying to tackle. But as you go through that journey of you've gone to market, then how did you address it? How did you pivot? How did you learn? How do you put that learning back into solution building and making it right for that customer set is absolutely the next sort of spike in terms of, I love using the word spike, but that important the important sort of metric or variable that we're looking at that differentiates you from your competitors, how quickly you learn, how quickly you adapt, and that fluidity. And that over time changes, right? So how you go from learning, adapting, fluidity to finding the things that work and really selling them to the market. The sort of the leadership that goes with it and the adaptability of the team and what they need to do next is also very important. So at different points in time, you're looking for different cues of what part of the founding team and skill sets are being addressed and being utilized by what they're building as well.
I'm also super curious in this region, are you seeing a lot of solo founders? Or are you seeing founding teams? And do you have a preference?
To be honest, from what we've seen is the vast majority have been founding teams. We've seen solo startups, but the vast majority have been a group of people or a couple in some cases. And my personal preference has always been, how do you complement people with different skill sets? I mean, you could have the best builder, but that person on their own as an engineer building a solution without the ability to sell or having the right people around or the skill sets to sell is doomed to fail. But at the same time, if you have someone who is a great seller but can't build, I mean, you need to complement the right people. And I feel right at the start, having them mission-driven as founders to build towards that mission that they have with the right complementary skill sets that then they complement with others is great. Having that on one person is just a huge ask. I think it's doable, but as long as that person is very well versed on where their shortcomings are and how they're complementing that. And that's a huge ask on any individual. I think there are people who are very good at that and are able to complement themselves with where they see their shortcomings are. But I do have a preference for a couple of people who have this constant dialogue that communication matters and understanding where they do have their strengths and where they do need to complement those strengths with other strengths.
I love that. Okay. I want to talk to you forever, Nader, always, whenever we're having discussions. But we do have to end this at some point. So I've saved a juicy one for last, which is, in the current market climate, we have, compared to 2020, 2021, where the market was super frothy and everyone had FOMO and everyone seemed to get funding. A lot of the entrepreneurs today, looking at first-time fundraising, will be talking to some startup founders that got funded in that time. But fast forward to today, we've got, expensive capital, high interest rates. We've got a little bit of maybe even some PTSD from the graveyard of startups that we might have seen over the last 2 years, just high valuations, recorrections, all of that. What advice do you have for entrepreneurs today? And you could break it up into both, right? Those that are fundraising again, what's changed from when they fundraised a few years ago? To new founders that are fundraising for the first time, what advice do you have for them to fundraise in this market right now? In 2024, we're sitting here, beginning of Q1 2024, fundraising in 2024, what's changed and what advice do you have?
So I'm very, very bullish about what this year is going to look like overall for the industry. But I'd caveat that with the macro environment as well. We are getting hints that interest rates are going to go down when there are vast sort of expectations that vary. But at some point this year, there's an expectation that will start working its way down, which is positive. That means valuations will look positive in the years to come. But at the same time, that the zero cost of capital marketplace is not going to come anytime soon. And what I want to break up sort of my answer to your question is into two fronts. Number one is there's an opportunity cost of investors coming into funds who then have expectations of the funds to deliver. And number one is that opportunity cost of high opportunities in terms of returns, and the high cost of capital means they want liquidity faster than they've wanted in the past. So where we had almost zero cost of capital in the past, or very low interest rates, let's say, the ability for funds to say, you know what, we want to extend to being a 15-year fund or being a 20-year fund, and having those lock-ins was okay. Having those chats at that point, although it wasn't common market practice, it would be okay. But now the expectations are going shorter and shorter and shorter. So one thing that I'm wary of is the pressure is coming from an investor group that's saying, I want returns faster than before, which would mean we want businesses to get to a point where they're cash flow positive, profitable, potentially an exit opportunity sooner, whether it's to PE, whether it's to corporate venture arms, to corporate M&A players, or even the IPO market. Getting to that point faster is something that I feel will become sort of part of the trend of the next few years. So getting there faster is one thing that comes to mind. The other end of the spectrum is the customers as well. So as consumers, I mean, the biggest cost burden on the most consumers globally is the cost of mortgage. And that's at the highest point it's been in a very long time. Cost of living and the inflation pressures of the last couple of years have caused consumption changes. So that's consumers, but the same thing's happening on an enterprise perspective. They've had to consolidate, rationalize their spends. So making sure that solutions are of cost benefit or or that one solution that consolidates a few of the problem statements for whether it's a consumer, whether it's an enterprise customer that you're looking at, is a bigger theme that I'm sort of seeing a lot of movement in. We've seen that in the last year, and we don't see that, or at least my perspective is that it won't change anytime very, very soon. So how do you become that real estate play on someone's phone, or that one of the handful of vendors that I want to deal with as an enterprise, as opposed to when it was cheaper to try things out, expectations were lower from their shareholders. They're willing to try different things to find something that optimized their needs. So on the two fronts, I'd say, how do we get to a point where you are solving for a bigger and bigger need, and on the other end, making sure that you're not bloating yourself when it comes to your costs, developing out of hand, and having a very controlled environment in which you're solving for direct needs and being very close to your customers.
So it sounds like it, as we've seen over the last few years, raising capital is getting more difficult. For startups that may have raised funds a few years ago, they might not have a big enough vision now, might not have a big enough mission or addressable markets to really capture the capital that's on hand. And of course, we were learning from the last few years of experience that everyone is saying people have to be, and entrepreneurs have to be much more disciplined with how they're running their companies. Are you seeing that happen?
We have seen a lot of changes in how entrepreneurs are being more diligent about costs and increasing those runways. Because they've noticed the fact that VC investments took a hit in the last year and a half. And on the other side, it's becoming expectations of their boards, of their shareholding, and their advisors to make sure that they're creating that runway and making sure that they're controlling costs for various reasons. So one is on the investment side, one is on where's the market heading. There's a lot of uncertainty, the variances in terms of where the market's heading, in terms of outlooks, expectations, has been quite volatile. So being a little bit more calculated has been quite the theme of the last year and a half, and we see that going forward. And the other part of it is expectations as well in terms of valuations. When the cost of capital was lower, valuations were quite high, and obviously there's a correlation between the two numbers, right? So as the cost of capital goes up, valuations go down. So even as a business, if you've built up a bottom line that's as healthy as it's ever been, there is potentially a correction, and a major one in that valuation that comes forward, and that it goes two ways, right? So one is for the founding team and their expectations of what they're looking to raise and what that means in terms of dilution, but then also for their investors and making sure everyone's aligned in terms of the needs and the next steps of the business, and that valuations in some cases, in the best cases, might be a slight uptick, but in a lot of cases might be flat, or in some cases lower.
Okay, well, you heard it here. Any last piece of advice, Nader, in 30 seconds? What do you want to tell the entrepreneurs out there that are going, oh, sounds pretty tough? What are we meant to do?
Do what you're passionate about. That's my sort of couple of lines or a couple of words that I think I need to say constantly is don't do what you're not passionate about. You will burn out. You're likely to fail. But if you're really driven by what you're solving for, please go at it and go towards whatever that is. If it's worth your time, then definitely do it.
I love that. That's the same advice my parents gave me when I was young, and I think it's sound advice. Amazing. Thank you so much for spending your time with us today.
Thank you for having me.
Yeah, you're
great.
Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.